Whereas the stock market and public equities has traditionally been where investors have allocated their dollars, private equity as an asset class behind the curtains has become a titan. Here's private equity assets under management as a share of US GDP. In today's video, we take a deeper look at how private equity has taken modern finance by storm. So there's private equity and there's public equity. Equities that are public trade on stock exchanges, their financials and relevant filings are all there and reported on for us to see. But with all this talk about shareholders and just the jargon that's associated with that, there comes a certain amount of headaches. Because when you are running a publicly traded companies, there are regulators, shareholders, analysts that are constantly scrutinizing you. Think back to a job you've had in the past where you were excessively micromanaged by a superior. Your every move is being watched. That's kind of like what running a publicly traded company is like. Every action is reported, your every move. A long time ago, companies didn't have a choice but to comply with this arduous task. You needed the public's money to raise capital. But times have changed. Modern finance has evolved, and readily available capital in today's economy is like never before, meaning public equity is no longer sexy and private equity is in. Which may explain why the number of publicly traded stocks has gone down. In the late 90s, we saw a peak where around 7,000 to 8,000 publicly traded US companies were on stock exchanges. Now, the dot-com bubble and the Great Recession, a number of years after this peak, would explain why the trend went downwards. As the economy contracts, business is no longer booming, maybe some companies file for bankruptcies, and some companies go private. However, post-Great Recession 2008-2009, the economy has been booming, so you would expect for that trend to go back upwards. Not necessarily the case. The attraction with being a publicly traded company have dissipated as more alternative and attractive methods have arose, one being private equity. Whereas the stock market was once participated in by the rich white man, this has changed. In the last half century, the democratization of public markets due to technology, easy availability, and low fees, such as discount brokers, has meant mass participation. Today, nearly half of the American population is invested in the stock market in one way, shape, or form. Unlike the stock market, private equity is still a rich man's game. Investors in this space are usually fat wallet institutional investments, university endowments, or wealthy individual clients. The quantity of private equity firms has ballooned. There are over 4,000 now, and the deal activity over the years again has ballooned as well. In the last decade, we've seen billions of dollars pour into private equity deals. Going forward, it seems private equity will only continue to grow. We are in an environment where private equity will thrive. Let's look down the checklist. First, low interest rates. Whereas fixed income securities and other debt instruments tend to falter during low interest rate environments. After all, the yields go down and that's no longer attractive. Private equity thrives during low interest rate environments. After all, private equity deals often involve a lot of debt. When this debt is cheap, that only juices up returns. Another is politics. Hedge Fund and Wall Street titans have been in the political crosshairs as public enemy number one post-Great Recession. However, private equity has largely been able to operate behind the curtains with little to no publicity. Maybe that's changing ever so slightly now, but nevertheless, for years and years that hasn't been the case. With stock markets more volatile and seemingly affected by Trump, trade wars, and geopolitical tensions, private equity investments do not have to deal with the day-to-day volatility, which means that there are a long list of clients lined up to diversify their portfolios to to look for alternative returns, and where else are you going to look than private equity? But with the number of private equity firms rising, some argue that these strong returns are in the rearview mirror. Competition is intensifying, and the flow of capital between countries is tightening up, meaning it's becoming harder to invest in foreign projects, given the rise of protectionism. As the pages continue to flip and the dawn of a new decade emerges, it'll be interesting to see how private equity managers navigate through this more volatile world we live in.